Good evening and welcome to tonight's live webinar where we look at ASX investment opportunities in review for the 15th of March. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. The data up on screen there is the history of the algorithm models. If you were to take all 100 positions or the true signals within the 100 of the ASX and the S&P 100, the performance data is up there, where the 5-year average outperformed the S&P by approximately 4% and outperformed the Australian market by just under 8%. Part of what we'll be looking at tonight is obviously running through which stocks are under buy conditions, and maybe once a month we'll start to look to include something on the US. But if you have an interest in US stocks, please give me a call and I'm happy to walk you through some of the recent performance on the algorithm model there. The broking account service that we provide incorporates access to our model portfolios, the 20, the 50 global ETFs, as well as our high conviction portfolios. We run an independent portfolio where we can work in partnership with you to execute specific ideas, and we also have access to derivatives to enhance portfolio returns. For people joining us for the first time that may be on a trial tonight, the annual subscription to the technology is $1,320, and it's the Investor Signals member area that you would have access to during your trial, and that's the same technology and tools that I'm using to present tonight. For more information on the 3 primary services that we provide, the research, the brokerage account or the managed fund, please contact the office. Up on screen's a graph of the Nasdaq. What we've seen is a correction from approximately 14,000 points in the Nasdaq back down to around 13,000 points, a little bit below. We've had a rally over the back half of last week, and what we'll be looking at tonight is, do we get a continuation of that correction in these high PE names and the rotation that's been occurring into the value names, and what does that mean for portfolio allocations? We're still a little bit cautious on the Nasdaq, and let's have a look at the index a little bit closer here up on screen. So that's the same graph that we just looked at. Obviously we've had an extremely strong rally off those March lows. A big part of sort of this second wave of the rally, if you like, was really driven by PE expansion rather than really continued earnings growth. We've seen interest rates start to rise off extremely low levels, so we're really back to levels that we were slightly pre-pandemic. And we've seen this correction in the high PE names that we've been talking about. So the trigger here was the Nasdaq trading below that 10-day average, and we had the correction from just under 14,000 points through to the low there of at about 12,400, and now we've rallied back. We're above the average. So you can see here what I've done is just put a support line right in under those lows there from Thursday night, or from Wednesday night it would be. And really the reference there is that the price action's above the moving average, so we're interested in keeping an eye on this for a break below that average again and a close below that support line. And we still have a backdrop where valuations are stretched in these tech names. If we look at a couple of the other indexes, just the S&P 500 and the XJO, the S&P 500 is under buy conditions. It's rallied back, creating almost a new high, and that's reflective of the higher weighting towards some of those traditional value names, especially companies that are tied to travel, energy, and businesses that are perceived to benefit from a reopening of the global economy to some sort of normal activities. So the S&P 500 is getting the benefit of sort of the outperformance relative to the Nasdaq. Our own local market, again, the XJO has a reasonable amount of constituents that would sort of fall into that value category, obviously less so the Nasdaq, but the XJO If we zoom in and have a look at what the key levels here that we're looking at, so the prior high at 6940, a lower high there at 6860, and support at 6650. So for the moment, the view is that the XJO is really trading sideways within that support and that first resistance. If we look at the stochastic, it's turning higher, and we have less of a valuation issue in the XJO than obviously the Nasdaq. So still consider the Nasdaq as a bit of a leading indicator for that correction in those high PE names that we've been talking about. As far as our local market goes, and probability is that the valuation trade is probably getting fairly close to completing, the easy part of the correction in value, that it's had. So it seems reasonable to expect, for the most part, resources and banks to move sideways, which would lead into probably the XJO staying within that band, and I'll draw your attention to which way it breaks out of that on the blog as a point of interest. With that, let's move into the top 100 stocks, and I'll move through these fairly quickly and just share with you a couple of key thoughts on them and highlight the names that we prefer in portfolios. So for those joining us the first time, the process here: select the ASX 100 from the watch list, get the greatest percentage gainers to the top by clicking that column, organise them in buy order. So as I toggle through these, we'll be looking at all the stocks under buy conditions. We'll get a certain way through the list, and I'll just highlight to you when it's shifted to sell. And as we move through the stocks that are under sell, I'll highlight which ones we're looking at on the short side of the market and which ones we think there might be a counter trend trade there, where they've got a little bit oversold relative to where their earnings growth rate is at the moment. So starting with TPG, we continue to like this. The stock goes ex-dividend tomorrow. The earnings result, as I spoke about in previous weeks, was really uninspiring, but we should start to see a slightly better performance as we get an increased dividend payout following the consolidation with Vodafone, and look to see TPG trade back up to around that 750 mark. Fisher Paykel, this was a short-term trading opportunity. I've highlighted this on the blog throughout the end of last week. $26 support has now rallied up to 28. For shorter term traders, you could even take profit, the move from low 26s up to 28. Maybe sort of 6-7% gain. If you're looking to let the rally run a little bit more, one of the ways of doing that would simply stay long the stock as long as it stays above this 10-day average, and that might give you the opportunity to capture a more meaningful rally there. The earnings growth in Fisher Paykel is tremendous, but it does trade on a high PE. Qantas, we hold this in the model portfolios. It's a stock that sits in the top 50 model, and it's been added in off that support line there of around that 450 level. To me, it's kind of defies fundamentals, but obviously with the government stimulus programs that are being provided towards discounted travel domestically, we're likely to see a return to strong capacity numbers for Qantas domestically. The international picture is probably a little bit more difficult to get clarity around, but the market seems to be a long way ahead of itself with the bullishness around Qantas, but obviously it's a popular theme as a way of playing that reopening trade. IDP not doing there at the moment. We'll revisit that on the next buy signal. BlueScope's performed well. Buy signal there at around $16, so now pushing up to $19. Lendlease, we like this. So if you're looking for something that's got a reasonable risk reward ratio in the Lendlease is it. It sits slightly higher at the higher or riskier end of that spectrum, but the long-term prospects for Lendlease really are substantial and attractive. So tough operating environment over the last 6 months, but it's unlikely to go down and retest these prior lows. So really stop and have a think about sort of Lendlease and where that could sit in your portfolio. Evolution Mining, preferences in Newcrest and Northern Star over Evolution, but gold's obviously started to just get a little bit of buying interest. We're seeing it back up to $17.25 US an ounce. Goodman Group, development pipelines twice what it was this time last year. The company's forecasting earnings growth double digits, so over 10%. Does trade on an expensive PE as we've looked at in the past, and a fairly low dividend yield. The correction from $20 down to $17 is material. And I've highlighted sort of, hopefully it's finding support where it is at the moment and it's back above the average, but you just need to be prepared for it to trade into that consolidation range. But traders, you might think about buying that with a stop below the moving average. NextDC struggle with that, but it is under buy signals. Cleanaway, we like this. I think it's important to have this in your portfolio, especially as the company seeks to finalise the takeover deal with Suez Waste Management. Cleanaway at around 230, new CEO in place, 2 and a bit % dividend yield, maybe big takeover opportunity there yet to be finalised. Could see that trading 260 in 12 months time, and it's fairly low risk as far as downside shocks go. Mirvac Group, look, preference still that SLF ETF, so that just gives you broad diversification to the property trust area. And I'll update a blog post tomorrow just with a snapshot of that SLF ETF. But Mirvac under buy conditions, as we've looked at with a number of these property trusts at the moment. Beach Energy, preference Woodside over Beach, but Beach has a good 2 to 3 year development story with new production coming online, and oil prices up in the mid $60-70 a barrel. It's a reasonable operating environment for Beach. Newcrest, value opportunity here, probably Northern Star is still the more attractive choice at the moment, but in order of preference, probably Northern Star, Newcrest, Gold Roads, but having the basket exposure to some of these gold names, and whether you do that through the stocks or think about the GDX ETF or even the miners ETF, all worth considering with the correction we've had lower in gold price and the recent buying interest pushing it back up to 17.25. GPT not doing there at the moment. SLF over these individual stocks. ALS under buy conditions now. CSL, we think this provides a good buying opportunity, and you're really thinking about this from a much longer term perspective. Their blood plasma collection centres obviously would be impacted from COVID, and the concern is that starts to show up in the earnings results for the next 6 months, and part of that is being driven by the fact that CSL never upgraded their full year earnings, even though the first half was so strong. So whether 250 turns out to be the low point of this correction, but it might be another stock that you think about for investors, buying it here and then adding more to it if we were to see it touch that lower level there within that range, which would be around 220. But I suspect we're getting pretty close to the support level in CSL, and you'd want to be thinking about increasing your exposure to that now. Woodside we like at around this $25 level, that's good value. WiseTech, not sure on that one. Atlas, not sure there, but these are all under buy conditions. Cochlear performing well since the algorithm. Cube back at fair value around $3, but obviously up substantially from the last signal. ASX, we think this is corrected to the downside to a point where there's value on offer here. Again, if you're a long-term investor, the 3% fully franked dividend yield's attractive. Owning it here, maybe leave room to add a little bit more to the position in a soft market. For traders, these periods where the stock price moves above the average after it's got down to these oversold levels, stochastic moving higher, you might want to think about using that as a reference. Simply as long as the stock price stays above the average, you stay in it, or maybe the stochastic, as long as it continues to point higher, you stay with the trade. But for investors, it's just a good long-term entry level there at around that $69 level. Seek, we like this, but recognise how expensive the stock is. and bit concerned that if we have another leg lower in the Nasdaq, that we see Seek retest that $25 level. There are growth names that we are adding to portfolios, and I'll get to those shortly. Woolworths, reasonable opportunity here, $39. You've got the spin-off of Endeavour Drinks coming up, likely mid this year. But the probability of Woolworths and Coles surpassing the growth rates that they had over the last 6 months, which just sets up a trading range or a consolidation range more so for both Woolworths and Coles, given that they're unlikely to deliver earnings in the second half that exceeded the first half. So one of the ways to capitalise on that is own the stock and sell a covered call over the top, where you're driving cash flow in between the dividend cycles. If you'd like to know more about that, call me in the office. Link Administration, we don't mind this, but not a high allocation towards that. Sonic Healthcare, we think this is a buying opportunity. The correction from 37 down to 31, buy the dip, support there at $30. Should trade back up to maybe $33, $34, so reasonable both on the trade side and on the for investors. Star Entertainment, both Star and Crown continue to surprise me, I suppose, how much the market's willing to look through the current earnings weakness into brighter days ahead. And Star's focused on the property development side of things maybe underpins the story here a little bit more. As far as the algorithm, we've seen it switch from sell conditions into buy conditions here at around this 340 level. It's now pushing 390. Aristocrat under buy conditions switched from sell to buy there at around 28, now pushing 34. It'll be interesting to see how their earnings continue to develop. The A2 Milk Company, so this is really corrected far lower than probably we would have thought. We're looking for support up here around this $14 level, and obviously we're broken through that off the back of 3 earnings downgrades that we've seen over the last 6 months. Most of that bad news should be priced in. Keep an eye on this just for a turn higher in the stochastic and a more substantial sort of break above that moving average, and I'll draw your attention to that on the blog. But we're willing to stick with A2 Milk and continue to monitor the news flow there. The XTO, which is the top 100 index, Amcor is a value play in the market, so we like this at $15. Obviously we liked it a lot more down at $14 when we were originally talking about it, but this has the potential to trade back up between 15.50 and 16.50 and consolidate within that range, but should have a reasonably strong earnings profile of at least high single digit earnings growth that Amcor's able to deliver. APA goes ex-dividend in June, and we're looking for a return back up towards that $10 level in APA coming into the June dividend. Coles Group, as I mentioned earlier with Woolworths, the market's recognising that the next 6 months is not going to be as good as the past. Coles has actually flagged that, and that was responsible for this correction from $18 down to $15.50. You would assume we're getting back to levels that will be supported by the 3.5-4% dividend yield. So I've created this range here from around $15.50 down to $14 on the downside. We're probably at $15, we're back at a level where we're likely to get some buying support building. We can see the stochastic starting to turn back up, and we may be looking at a bounce back up to around that 16.25, 16.50. And then I would suggest that we're probably back near resistance at around that level, and we're likely to get into more of a consolidation phase. We're up the top end there at around 16.25. You might start to think about selling calls over it to drive extra income. Northern Star, patient with this one, but we think it offers a good recovery opportunity. The synergy costs from the merger with Saracen and a backdrop of a slightly improving gold price. We'd want to see that gold price continue to cross back up above 1800 an ounce before we really started to see Northern Star turn around, but I think that's only a matter of time. Computershare, not doing too much there, but if we just look at the history of the algorithms, switch from sell conditions into buy conditions at around $12, and it is a holding in our top 50 model. As is CBA, it's the only bank out of the four that are in the model. Appen Group, not doing there at the moment. Sydney Airports, again, surprises you how the willingness of the market to look through current earnings. If we go back to where this stock was pre-pandemic, it was really trading sort of more around that $7.50 level, which put the stock, I think, from memory, on just over, say 4% dividend yield. So, in a good market, that's where it can get back to, around 750. Not sure that we see these highs in a hurry, which were really prior to the pandemic in the November period, especially if we're seeing interest rates creep a little bit higher. But Sydney Airports is in the model. JB Hi-Fi is in the model as well. The original shift from algorithm sell to algorithm buy here created the entry at 21, subsequent signals there, and then again on this recent correction from 55 back to 43. But again, the consensus in the market is that the next 6 months for JB Hi-Fi won't be as good as the prior 6 months. Car sales, this is a buy on the dip opportunity, so this is one of the technology names that we're comfortable with buying. So the entry level could be around this sort of anywhere really from 18 down to about 16.50 on the low side, but we think that that's getting pretty close to an area where you want to start having to think about adding that into portfolios. Charter Hall, not doing there at the moment. Suncorp, I noticed that a number of the investment banks are starting to upgrade the earnings outlook for the Australian insurers, and they rate both Suncorp at the top of the list, followed by Insurance Australia Group. So when we look at the algorithm here, it's switched from sell conditions into buy conditions at around that 960 level, and it is pushing higher. It's a holding in our top 50 model. Illumina now under buy conditions. Soul Pattinson under buy conditions. Aurora under buy conditions. I've been highlighting the return to earnings growth here, supported by a good dividend yield, as well as the company buying back its own shares. But that sort of low risk part of that trade has really already played out, and I see it sort of back at fair value where it is at the moment, so not sure it races too much higher from where it is. Transurban at around this sort of $12.50, $13 looks like a reasonable opportunity. If you're going to sort of look through pandemic impacted markets for opportunities, Transurban seems a reasonable one to consider. ResMed, again, high PE within the medical space, but obviously growing earnings at double digits. The correction we've had from 30 down to 24, maybe on the downside down to 22.50 in a soft market, but getting close to support there, and that's under buy conditions. Wesfarmers we like, but again, probably not likely to see the next 6 months earnings exceed the prior 6 months. So support there at around 50. Expect more of a consolidation pattern out of Wesfarmers. Domino Pizzas, support there corrected back from 110 back down to around 80. Found support just above that. Now trading 92. We had the buy signal originally at 72, and then another buy signal there at just above that $80 level. Downer EDI now under buy conditions. You might want to think about that, or CIMIC as a way of getting exposure to Australian infrastructure. Stockland's under buy conditions, not doing there. Xero, I think, so the two technology names that we like within the top 100 are Xero and Car Sales. Xero at around this sort of 110 to 115 level looks like a reasonable entry. Again, be prepared for if we see bond yield spike in the US, the Nasdaq sell off. You could easily see Xero, on a further leg lower, breaking that support sub 100. So the way to approach this is just scaling your position size. So having half the position size set here, and maybe another half if you see it test at that lower range. But the underlying business there for Xero continues to do well. REA, we just struggle with this on a valuation basis, up at 60 odd times earnings, just too expensive. Altium not doing there at the moment. Fortescue. Corrected off its highs from 27 in line with iron ore pulling back. Watch out for the next algorithm buy signal there in Fortescue. I expect if we look at the history, we had the signal back there, again there, and I think we're getting into a range where another little correction lower will trigger another buy signal there. Afterpay, this is the poster child of the high PE correction in the Australian market. We've seen it correct from 150 down to 108. Probably has further to go before it finds support. Magellan Group, so we've now switched into stocks that are under sell conditions. Generally, I won't talk too much about buying opportunities within these, as they're generally rolling over and have lower lows, lower high patterns forming. Sometimes the counter trend trade, where the downtrend just gets a little bit too extended, there are opportunities to trade these on the break back above the average, and for traders just simply sticking with the trade as long as the stochastic remains turning up, or that the price action's above the average. So Magellan fits that mold where the underlying business is still strong, and the correction from this 65 down to 43 might be a little bit overdone, so you may see a little bit of counter trend move to the upside there in Magellan. Ramsay, income trade for portfolios moving sideways. AMP not doing it there. Ansell, high quality business, the PE is pretty reasonable, and earnings growth is likely to be sort of mid-single digits. So $35-$36 probably is close to support. The stock is under sell conditions, which is just reflective of the lower low, lower high pattern. So we do prefer the other names that we looked at. So your Fisher Paykel, Sonic Healthcare, we think they're setting up better. But just highlight that Ansell is still a high quality business and unlikely to have material downside risk. Origin Energy is another one of these stocks that are under sell conditions that you can think about as a counter trend trade. So this is oversold down here. Energy area of the market is gaining investor interest, and Origin's a beneficiary of that. So for traders, you could stay long this trade as long as it stays above that 10-day average. Santos, preference Woodside and Beach over Santos. Oz Minerals, a little bit cautious on copper in the back half of this year, but that's something we'll revisit in the next three to 4 months. Incitec Pivot not doing there at the moment. Dexus not doing there. Telstra, we think this is a good opportunity coming into the upcoming announcement around the bidding process for Tower Co. So that should be a net positive that boosts the share price. Kiwi Insurance not doing there at the moment. Reliance Vicinity not doing there. IGO not doing there. ANZ, we think the Aussie banks have rallied and back up against resistance now. Maybe the exception there's CBA can bump along sideways a little more, likely to get a little bit more downside support CBA, but Westpac, NAB, ANZ look to be up against resistance where they are at the moment. Oil Search not doing there. Woodside preference over Oil Search. Tabcorp up against resistance. Challenger we don't like, up against resistance. Reece not doing there at the moment. Worley's not doing there. Within that sort of whole, CIMIC still our preferred infrastructure recovery play in Australia. Orica not doing there, could be getting a little bit oversold. Insurance Australia is a recovery play to think about. Likely to look back and see in 12 months time and see Insurance Australia Group back up around that $5.50 to $6 range. Crown, obviously some issues with the outcome around the licensing review there. Boral getting back up to near full value. NAB up against resistance. AGL just avoiding that at the moment. Macquarie up against resistance, but as I spoke about last week, we're seeing a substantial improvement in the earnings picture for Macquarie. BHP, iron ore a little bit soft at the moment. I expect BHP to switch back to algorithm buy signals. If we see a more material correction, maybe back to $42, we'll see that shift to buy signals and it'll be added back into the models. Brambles, don't mind that from a valuation standpoint. Nine Entertainment up against resistance. Centre Group up against resistance. South 32, preference Fortescue over South 32. Horizon earnings trending lower, under lower low, lower high. The most recent signal there's the algorithm sell up the top there, and we had resistance there at around $4 and it's trend lower. AusNet was shifted out of the model portfolio today. Wasn't a high earning contributor, but about 5.5% return for holding it for 3/4 of the year, so let's say around 9 months. Spark Infrastructure under sell conditions, not doing there at the moment. Treasury under sell, Medibank under sell, Ampol under sell, but Ampol probably getting down to a level where it's likely to find some buying support around that $23 level. Mineral Resources, so similar to BHP, we'd expect a more material correction lower here and a shift to buy signals, and that'll be the point that we really focus on the opportunity there. Bank of Queensland, we think the regionals are at more risk than the major four, but so if the banks are in the nearing levels of resistance, the regionals, so Bank of Queensland and and Bendigo likely to underperform, and they really have since their earnings results. Rio correcting from 130, now 115, maybe a little bit lower down at 105. We'd see that switch back to buy signals. James Hardie, would be looking for that back down to around $30 and a switch back to buy signals. And there we are, back to TPG. Just to look at a couple of ETFs that we've covered. So GDX, I mentioned earlier in the recording, we're starting to see that move a little higher off the support there at around just sub $40. The other one that I mentioned was Miners, so which is the BetaShare Gold Miners, so support there at around just under that $6 level. Some of the so other ones that we've been active in is the MOTE ETF, so that sits in the high conviction portfolio, so that gives you really exposure to global high operating moat businesses, which at a reasonable valuation. So the ETF tends to avoid really high PE names, and as the value trades continue to build momentum, this MOTE ETF's been a beneficiary of that. So it's been under buy conditions for a number of years, so originally from back at $55, but if we just look at the more recent trends, a buy signal there at 78, and then sort of in that March period a buy signal there again. So it's a real high quality asset allocation here within this ETF, and it's doing well. Similar holdings, but excludes Australia, is the equivalent, which is the GOAT ETF. So that one has been performing well. We're holders of that. The Cure ETF, which is the biotech ETF. So we've been buying that on the dip, and I mentioned that on the blog. One that hasn't performed as well as I would have expected, especially in light of the strong Chinese economic data that's come out, is CNews. So continue to watch this. Closed on the session lows today. If we were to see it a little bit lower down there at around that 780, you might want to start taking a lot closer look at that, or simply be patient, wait for it to trade back above that moving average, but keep that one on your watch list. And so I think that covers most of what we've really been looking at. So maybe just to finish tonight, just a quick look at the recent posts that are being put on the blog. So if we just recapture these opportunities, so I'll move through these fairly quickly. So Fisher Paykel we still like, so high quality business, good growth. Gold Roads is one of the, so I listed the three: Northern Star, Newcrest and Gold Roads, as recovery plays on individual stocks within the gold space. Goodman Group, we continue to like that. I think there's space for that. Cleanaway rates high on the list. Beach, probably Woodside above Beach. Newcrest we like. CSL, value there, buy that. Woodside, buy Woodside around 25. Cube moving sideways, but high quality business. Keep an eye on it for a pullback. ASX, we like this at sub $70, that's a buy. Sonic off the $30 support's a buy. Amcor, high quality business, you want to own that. APA, we're looking for that to recover into the dividend. Coles, yes, but growth moderating. Northern Star, benefits coming through from cost synergy with Saracen. CBA, maybe a little less downside volatility than the other banks, but some of the other majors, or in particular in the regional banks, we think are maybe a little bit susceptible. Car sales we like. Transurban we like. ResMed maybe back down to around support. Just give it a little bit of space and think about entering ResMed in two different transactions. One at sort of near current level and one maybe at 22 or a little bit below. Domino's, recognise under buy conditions, are performing well, but we're not doing too much in Domino's at the moment. Downer EDI, Simico is our preference, but Downer still delivered good earnings result. Xero we like, and this will be one that you create that double entry, one at the current level, and then if it does trade a little bit lower, add to it, or alternatively just be patient and wait for it to trade back above that average. Origin Energy, breakout trade, sort of counter trend. NAB, bit cautious there, up against resistance. Brambles, value trade. Bendigo, regional banks we're cautious on, and then back to Fisher Paykel. So thank you for listening in tonight, and just to finish as a final reminder, let's go back in and just talk about the indexes here. So the Nasdaq, we're really watching this, recognizing that some strength there on this recovery or the rebound that it's had off the lows, puts the price action above the moving average, and for that reason you just want to stick with the theory that the market's moving higher for the moment, and you wouldn't look at short positions or building any new short positions in the market until you saw the Nasdaq break below that moving average. The US S&P a little bit stronger, which reflects the value trade, or the rotation from growth to value, and the S&P is benefiting from that. And then the XJO, support here at 6650, it's bounced off that. It is above the average, but likely to stay within this range with the first level of resistance at 6860, and I'll draw your attention on the blog as to when we get a break either above that or below that support line. Thank you for listening in, and if you'd like to discuss more about our model portfolio services, whether it be the broking account, the subscription, or the managed fund, please don't hesitate to give the office a call